Thank you all for joining us today for our webinar, How to Rebuild Your Credit. My name is Kelly Schweppe. I'm the Program Marketing Specialist here at General Electric Credit Union, and we're so glad you've joined us for today's topic. We have a lot of great content ahead, and we're excited to be able to continue to bring you advice from the comfort of your home, work, or wherever you are today. And with that, I'm going to turn this over to Todd Moore with Trinity Debt Management to introduce himself and take us through today's topic. Todd?
Thank you so much, Kelly, and thank you to everyone who is on the call today on this cold, snowy February afternoon. It's always great to be back with everyone, and I appreciate you spending time with us this afternoon. I'm Todd Moore from Trinity Debt Management, been a longtime partner with General Electric Credit Union, and look forward to sharing this afternoon some great information about ways that we can rebuild our credit and improve our credit capacity over this next year. Okay, so, one of the things we think back, it's almost been a year now, COVID-19 and all the challenges that we've had over this last year, whether it be, job loss, diminished hours, all these sorts of things that we've had to deal with over the last year. Thank goodness that we're heading into a new place and we have a vaccine. Many of us have had significant challenges around this question of credit. And what I wanted to do today was walk you through, we actually had quite an ambitious agenda ahead of us today, but I want to walk you through what I call a credit building framework. So if you notice on our slides here, there's basically these 5 steps. And think about this as these 5 steps that are interconnected that move us everything from just considering our credit goals to all those practical steps along the way, from scoring to some of the practical steps and products and services that we might use through General Electric Credit Union, and then really putting all this together to make it count. So I'll introduce the framework to you, and the intention today is really for you to be able to go back and apply this framework long after this presentation is over. So the first step along this journey, this framework that we're introducing you to today, is I want you to think for a moment about what your credit goals are. And really, it's important for you to really think about what your short-term and long-term credit needs are at this moment in time. So I want you to write those down. And for most of you, you're probably thinking about these already, but here's a couple examples. So when we look out into 2021, are you looking to purchase a car? You want to be a first-time home buyer? Do you need a personal loan to pay something, to fix something at the home or some other larger credit goal that you have in mind? You want to be able to clearly identify that, because what we're aiming to do is we're saying, okay, here's the goal, and then what products and services maybe do I need to reach that goal? So I wanted to provide you with some action steps here. So, this is very much about getting you prepared so that you can walk into the credit union, get the product that you need, the credit line that you need, and help you with your credit score so that you can accomplish those larger goals this year. So, a couple practical steps. If you're thinking about a loan, one of the things, if your credit score may be diminished at this point, or maybe you're not quite where that's at, I want to encourage you to really reach out to General Electric Credit Union, talk to a loan officer, find out what that minimum score requirement is. So if you're thinking about a car loan, personal line of credit, home loan, what's the minimum score that I need to qualify for a home loan? Here's my score now, this point in time, but I'm really interested this year in obtaining a home loan. So where do I need to be? What's that minimum score that we're looking for? And the same for other lines of credit. You can always reach out to a loan officer at the credit union, and that will give us a baseline and let us know. So if your score is a little lower, then we know we have an outcome that we're reaching. We know what that score needs to be down the road a couple months, or we know what that minimum score requirement is. So that's a very practical tip, an action step that I'm going to encourage you to do now, is think about what those credit needs are and what's that minimum score requirement that we need to reach that goal. The other thing that you can do is you can reach out and talk to me. Longtime partner with the credit union, very much want to help you. And what I can do is really I can work with the credit union to help you along the way. So we'll know what your baseline score is, whatever your score is now. And then knowing that we have a minimum score requirement or that personal line of credit that we're aiming at, or whatever this line of credit is that we're reaching for, we'll know the steps that we can take so that we can align our credit building strategies to get you there. We'll get you the score that you need. So the last thing we want to do is we want to put some time dimension around this. We want to think about, here's my score right now in February. I know that I need a score of X. How long is it going to take me to get there? How am I going to reach that goal? So those are some of the things just immediately that we're going to start working on. Get you thinking about your credit needs. What's those minimum score requirements what's the minimum score requirement that I'll need to reach that goal? And let's put some time dimension around that so that we can work and align all this activity to be able to reach that larger credit goal. Now, I say this all the time, and we've done a couple different presentations around budgeting, but cannot emphasize this point enough. Having identified that goal, we know what our minimum score requirement is. Now we got to start lining some funds up to actually maybe diminish some of these credit card balances that we have. We're really trying to focus on the credit score itself. And the way that we do that is we absolutely have to have a budget. Cannot overstate this point enough. Fundamentally, what we're talking about is, just getting a good grasp of our income and expenses. We're always aiming to identify overspending and reduce expenses. But we're also trying to figure out a way for debt management. We're trying to say, okay, I want to diminish these. I have credit card balances. I know I have to reduce these credit card balances. How much do I actually have to work with monthly to pay these balances down? And it's this tool, a budgeting tool, that's going to help you get there. And ideally, what we want to be able to do is we want to create consistent payment amounts towards debt reduction. That's that time dimension that I talked about in the first slide. So if we know that we have 6 months, that's our goal. We know in 6 months, we probably will get to that score range that we're aiming at. Now I have to align some funds to kind of pay down debts so that my score moves incrementally through time, through that 6-month period, to really reach that larger credit goal. That's the consistency that you're going to need. A budget will structure the dollar amounts for you so that we can get there. That's where we have to really identify how much will it cost us monthly to really reduce the credit card balances down or pay off some of our other outstanding debts to really reach that larger credit goal. So I want to encourage you to really start focusing on your overall expenses, put together a budget, really scrutinize that budget so that we can find those consistent dollar amounts that we need to pay down debts. Now, I'll encourage you also to look at the General Electric money management tool. I'm often plugging this tool. I'm hoping folks are using it, but if you're not aware of it, this is it's a tool that the credit union provides to you. There's a lot of great information that's in there from tracking, and you can use budgeting through the money management tool itself. But it's a great way for you to have a tool that you can use through the credit union to really identify your expenses, reduce expenses, track your expenses, those sorts of things. So I want to encourage you to use that as you work your way through this process. And then lastly, we talk about automating the process. And really what I'm talking about there is having identified that I need $75 extra a month to pay off this credit card bill. $75 in addition to my monthly minimum payment. I know that I can pay this off, within a couple months, 6 months. I have a time dimension. How do I do this to make it as painless as possible? Well, we can automate the process. We can talk with the credit union. We actually can have those expenses transferred into an account that is set up specifically for, debt reduction. But we're looking for a way to kind of create a budget where we can automate electronic transfers, these sorts of things, where we can put funds into an account that help us with our debt management strategy. So I'll encourage you to reach out and speak with folks at the credit union about how to maybe structure an account that's dedicated towards credit building or debt reduction. Having that automated is an ideal way to get us there and stay structured through time. So now that we've got a budget, we've got a goal, we have time dimension, now we got to focus on this credit score. Now I get a lot of questions about these two types of approaches with credit scoring. We hear this a lot through, what about Credit Karma? Or, is it accurate? Should I be using that, or Credit Sesame? How is that different than some of the other credit scores? What does all this stuff really mean? Well, I want you to really focus here for a moment on what we call a Vantage score. You'll see that listed there in the third bullet point. One of the things there is that this is largely for educational or informational purposes. So lending institutions, they don't use the Vantage score to really make lending decisions. So I want to encourage you, it's great to find out and learn more about a credit score, but Credit Karma, Credit Sesame, these types of scores that are used and generated are not the same as what we're going to introduce to you this afternoon. And oftentimes you'll see a 30-point swing, positive or negative. Folks can sometimes be disappointed. They'll say, well, I thought I was a lot closer to my credit goal. Credit Karma told me that my score was X. And then they find out that, we run a different score under the different model, and it's just not accurate. So I want to correct that at this point and just say, we want to work around the three major credit bureaus, and we're going to focus on what we call the Beacon score, and I'll introduce that to you in a moment. But here's a couple examples of what I'm talking about. You'll see the FICO score range, and I'll introduce what those scoring ranges are, but you can see how FICO is different than the Vantage score. Vantage score is actually calculated differently. It's not used by lending institutions to make decisions. And the scores that are generated by the three major credit bureaus, those are the ones that will be used for really all lending, and it's the primary models that are used. So we want to focus on those scores. The Vantage score does a great job in getting folks interested in credit scoring and learning more about credit scoring, but it's just not an accurate read on our score. So as we go through this work of doing credit improvement and rebuilding our credit history, strengthening our score, we're going to bypass the Vantage score and really focus on those three scores that are generated by the major credit bureaus. And here's an illustration of really what I'm talking about. You'll notice that we have the three credit bureaus. Each of those models reflect a little different scoring ranges. They have to differentiate themselves, but they all basically have those same 5 factors that we're talking about. So the score that we're going to focus on today is really that 300 to 850, that Beacon score. And you'll notice that, Vantage score is not on this slide. That's, again, because these are the factors that I really want us to focus in on this afternoon. And these are the ones that you'll be applying, in our credit scoring model. So we're going to bypass Vantage score and really focus on the Beacon score. You'll see those 5 factors: payment history, outstanding debt, credit history, inquiries, and types of credit. And I'll introduce those 5 factors to you and show you really how you can answer the question, why is my credit score X? Whatever your score is at this point in time. So thinking about your overall credit capacity, and we'll call this T1, where we're at right now. This is where we're at in time at this point in February. Recognizing that we need to have a higher score to qualify for a home loan or get the car that we're looking for. One of the things we can do is we ask that question, why is my score X at this point in time? We'll focus on payment history for a moment. Now, this is the most important factor in your score. You'll notice in the previous slide, the point values. I won't go through those now, but you can refer back to those later. But what you have to look at is there's a lot packed into payment history. Everything from being positive, being late, that is being timely or having late payments. Think back over this period with the pandemic. Some of us have had to miss payments. There's all sorts of things that could have happened along the way, has an impact on payment history, which would have brought our score down. So now we're aiming to really create consistent payment history, have positive payment history moving forward. But then there's also things that are captured under payment history. I'll call this kind of the worst case scenario, where we're thinking about, tax liens, wage garnishments, civil judgments, all those sorts of things. That all gets packed into this payment history as well. Oftentimes, though, whether it's accounts that have been consistently late, that have been sent to collections, all that activity gets focused on payment history, and that really can have a significant impact on our credit score. So moving forward, we really want to create positive payment history moving forward as we try to reach that larger credit goal. So this slide is a good illustration of all those sorts of things that get packed into payment history that have an impact on our credit score. Next thing we'll look at is our outstanding debts. So if you haven't really had, collection accounts or things that were charged off in this last year, maybe you had some late payments, those sorts of things. This is probably, and for most folks, this is where we have to really focus our energy. And this is basically looking at our outstanding debts, or how much debt are we carrying at this point. Now notice here for us, what we really want to focus on is what I'll call the 30% rule. So FICO would say that we want to keep those balances below 30%. So think about this. As you utilize more credit, as you're spending more and carrying a higher balance, and it goes out beyond that 30%, each increment out towards being maxed out or 100%, each increment outside that 30%, that 30% range, what happens is it basically starts to lower our credit score because we're carrying more debt and we're more likely to be in delinquency or default. Essentially, it's creating more risk. So the way the credit scoring model works is that as you're carrying more debt, it actually will diminish your score. And for most of us, what we're trying to do is we're trying to kind of correct that. We're trying to figure out a way to align a budget towards paying down debts to bring accounts that are maybe well beyond that 30%, let's say 75%, getting close to being maxed out at this point. Our goal then is to reduce our outstanding debts so that we can incrementally start to move that score up over the next few months so we can reach that larger credit goal. So, take some time to really read through this slide because there's a lot of information in here, and certainly we don't have time to cover all of these today. But I wanted you to point out that, or I wanted you to recognize that credit debt ratio is really what we're aiming at. How do I shift that credit debt ratio so I can take cards and reduce those at least to 50 to 30%? 30% is what FICO suggests, and you really start to see the impact on your score. I'll be explaining more about this credit debt ratio in a couple slides here forward, but keep that concept in mind that as you move out beyond 30%, you're carrying more debt, higher the risk, lower the score. And this is a good kind of graphic to demonstrate utilization and how this is impacting your credit score. So what you'll notice, that high peak, you'll see that utilization, 1 to 10% down there at the bottom of our line. You'll see that higher score is reflected. Utilization is low, higher score. And if you look to your right, here we're at 71% plus. That's where we start to say, okay, we've utilized that credit line. We're well beyond that FICO rule of 30%. We're out at 71% plus. You can see how that diminishes your credit score. So this is a great example of how carrying a higher balance really is associated with higher or lower scores. So the next factor that we'll look at is our length of credit history. So oftentimes, as we're going through this journey, trying to figure out how to improve our credit history, there's a lot that goes into evaluating, when do I open or when do I close accounts? Should I leave these accounts open? What am I supposed to do? I haven't really used this account very often. Thinking about just closing it completely down. I see this, at Trinity Debt Management, I see this all the time. Folks work hard and they're trying their very best to get out of debt. And what they will often do is they'll say, well, I'm just going to pay cash for everything. I'm going to close these accounts down. I just don't want to deal with this anymore. I want to caution you on that. So let's follow the rules that FICO establishes. So when you close those accounts, what you're doing is you're actually taking what is active and open out of your credit history. So you're closing an account down, which also can change the credit debt ratio. So you're kind of giving yourself, it's a double whammy, okay? Not only have you broken the rule in terms of your credit history, you're being penalized by removing that from your credit history, but it also can shift that credit debt ratio. So it can have a really negative impact on your score. So what I want to suggest is that, again, knowing that you have a specific credit goal in mind, reach out, talk to us at Trinity. Let me pull a credit report. Let me do some work for you to help you along the way. But I also want you to reach out and speak with folks at General Electric Credit Union. You can always talk to one of the loan officers, and you might want to ask a couple of questions. Hey, I'm looking. I've got a couple accounts here. What's the impact going to be on my score? What can we kind of anticipate if I close a couple of these lines down? Or how will you view this as I go into a home loan? I want to close a couple of these lines down. Ask questions, because what I have seen is, as we get closer to one of our credit goals, sometimes folks can just start shutting lines down and have an adverse effect on their score. It actually will lower their score. And then we're back spending a couple months just trying to get that 7 points that we need for a home loan. So while it may look fairly straightforward about opening and closing accounts, actually there's a lot more to it. So if you have any questions about this, again, reach out to the credit union, or please give me a call so that we can kind of evaluate these accounts, make certain that you're not penalizing yourself, or have a penalty on your credit score simply by closing these accounts down. Next, we'll look at credit inquiries. And this is, basically we want to look at these two. I won't spend a lot of time on deduplication, but we basically have two fundamental approaches here with credit inquiries. It's pretty simple to differentiate between these two. A hard inquiry is basically any time that you're actually applying for a loan. You're asking someone to give you money. So that's a hard inquiry. That is different than saying I am having educational. Well, let me be specific. When we say educational and informational purposes, this is where you might run a credit report or something like that to look at your score. Or maybe this was through employment. Someone looked at a credit report, those sorts of things. Those things are soft inquiry. You're not asking anyone to loan you money. Whereas in the other instance, with a hard inquiry, you're actually applying and being evaluated in some way for a line of credit. So in this case, what we're trying to do is, as we're reaching those credit goals and trying to identify what our credit goals are this year, we want to be very specific. In terms of hard inquiries, we're only going to apply for those lines that we need. Oftentimes we'll see folks who will, try to open lines. My score, I think, is close. I don't really know. I'm going to apply for this and see what happens. We want to get away from that kind of behavior and reach out to the credit union and really work with us at Trinity. We want to be focused on a very specific credit goal and really only apply for the lines that we need. Deduplication, this is one of these kind of odd credit terms that you should know. Basically allows us to do rate shopping for home loans, car loans, or student loans. So you can have multiple inquiries within this 45-day period. And essentially what it does is, rather than count each one as a single hard inquiry, it captures all that activity so long as it's focused within that period of time, and it's just counted as one inquiry. So it doesn't penalize you, like some of the old rules did years ago, where each application or each time your credit report was run, that's a hard inquiry. That's no longer the case with this rule of deduplication. So the point that I want to make more importantly about inquiries is that, the credit union is that's where we really want to focus our energy. We have a specific goal and a credit score in mind. That's what our work today is really focused on. So we shouldn't have multiple hard inquiries. Our work should be very focused. It should be very intentional, because here we're going to be working with the credit union to identify a score range and the line of credit that we need. So our work is going to be very directed. So we won't have, we're not really looking to have multiple hard inquiries. Our work is going to be very focused on a specific line of credit and the score that we need. And then lastly, we'll look at credit mix. So of those 5 factors that we've introduced, credit mix, oftentimes this is important when we have to think about When we're thinking about credit scoring or just building a stronger credit score, sometimes, particularly if we're looking at a higher dollar loan, sometimes we have to think about this credit mix. For instance, if you only have a credit card or some lower dollar cards and you're wanting to become a homeowner and this is a loan in the $150,000 range or up that you're aiming at, do I have adequate credit to actually apply for a line of credit in that dollar amount? And this is where credit mix really comes into play. And again, I want to say this, very strongly. Reach out and talk with a loan officer at General Electric Credit Union. Have them look at your credit mix, so that the work that we're doing together today is aligned towards that, I'll call it product or service that's offered, that line of credit that is offered at the credit union. So in this case, what we're looking at is really trying to have this mix of what we call revolving and installment accounts. And I've got some examples down here in a slide. Won't go through all of those now, but what we're trying to look at is that we're not just trying to evaluate our credit capacity based simply on credit cards. Many of us will have, it's kind of built into our credit mix essentially is a function of, we've had a bank loan of some sort for a car. We've had student loans, we've had all sorts of things that go into what we call installment accounts, monthly payments towards this larger dollar amount that we've borrowed. But we really want to try to have some type of credit mix. I would encourage you, when we're thinking about our credit score, let's say, for instance, that we need a 680, to qualify for a home loan. We would want to say, okay, is our credit mix strong enough? Do we have, will this work for General Electric Credit Union? Okay, that's something that you can do on your end. Just pick up the phone and talk with the loan officer and, really be focused on whether or not we need to do some work on this part of your credit score. So when we think about rebuilding our score, think about those 5 factors and ask yourself, why is my credit score X? Why is it 625? And if I need to get to a 680, which part of those 5 factors do I really need to focus on? Is it reducing debts? Is my payment history a little weak at this point? What do I need to do to strengthen that part of my score? Or is it several different parts of this credit score that I really need to hit on over the next 6 months to get that 680 score that I need to get the home loan? That's really what I want you to take away from us going through these last 5 slides about credit scoring and the risk model that we have. So having looked at this notion of credit scoring and how that model works, and again, you going back, kind of digging through those slides, looking at your score, 625, 630, I know I need a 680. Here's where I need to focus on my work. Sometimes we have to also think about, again, those products or services that we need to get the good stuff going. So what does that really mean? I want to focus on what we call a secure credit card, okay? Secure credit line. So for some folks on the call today, we may have a score that is very low, and we need to figure out a way to really build some credit through time. I know I'm 2 years away from a home loan, not ready to do that yet, but it is certainly a goal. Right now, my score is in the low 620s. What am I supposed to do? I can't qualify for any other type of credit card. I don't have the minimum score to get the card that I need. Well, this is where the credit union can really be beneficial, okay? This is where we would look at just building a secure credit line. This is where I want to encourage you to reach out to the credit union. And, usually somewhere in the $300 range is really what we're looking at, smaller dollar credit line, where we can actually put cash up as collateral. We get a secure credit card. And what that will do is we turn cash expenses into an opportunity to build credit. So what I would do is I would utilize that. I just max that $300 out every month on things like gas and groceries, those sorts of things. I pay it off in full every month. Now what that will do is it reports back to the 3 bureaus, builds payment history for us. Now remember, we talked about payment history being one of the most important parts, the most important part of our credit score. So that's where we need those timely payments to build our score through time. So this is a great tool to use, and I want to encourage you to really reach out and ask some questions about these other two types of loans as well. General Electric Credit Union also has what we would call a credit builder line of credit, credit builder loans. This is an installment loan or smaller dollar personal line, somewhere probably in the range of maybe $500 to $1,000. So there's, and I just want to encourage you to use these types of products if your score is in that 625 range and you really are looking for a line of credit to build your credit score through time to get you to that next credit score level to obtain a higher dollar loan. That's really what we're trying to do. That's the notion of getting the good stuff going. That's how we get there. And then I've also offered a couple non-traditional approaches here. You've probably heard of Experian Boost. That's the notion of rent reporting. How this works is we basically sign up for Experian Boost, and then if you're renting at this point, let's say you live, in a larger complex, something like that, where the folks you're paying your monthly, basically the way this works is it turns monthly rental payments into an opportunity to build credit. So they participate, the lender would participate in this particular program so that you are recognized through your rent payments. And I work with folks here at Trinity who have done this, and it will have an impact on the score. It's not the same impact as what you're going to find through the credit products that you're going to find through the credit union, but it does report, it does show rent payments, and it is recognized by the major bureaus. So this is not anything to do with the Vantage score. It actually is reported to all three credit bureaus, but the folks you're renting from have to be part of that Experian Boost program for it to be reported, because there's a small fee on their end to do that. And then the other thing too is what we call a lending circle. And a lending circle is where you use, essentially, in most cases, it's our family. So think about our circle of folks that are around us at all times, our family. And what we do is we would create an account at the credit union. We know that we don't, we would use maybe a secure credit line, $300. That starts building us some payment history. But maybe we would create an account at the credit union where our lending circle is essentially our family who's giving us a certain dollar amount through time, say the next 12 months, to build a larger account so that in addition to using our secure credit card, we have some type of funds that are set up in an account that we've established. Our family is putting money in that account to help us build our credit goal. So that may be money that we use to maybe create a down payment for a first-time home buyer. It could be money that allows us to generate funds over the next 12 months to pay down debts. Maybe we just need some additional help. But those are two non-traditional approaches, things that you can apply, again, to get the good stuff going, to get that score moving, or to pay down debts. In both cases, the impact to our credit score is pretty significant using these tools or these approaches. And if you have any questions, again, you can always put those in the chat or let Kelly know, and I'd be glad to answer any questions around either of these two approaches. So let's do some applied work here. Let's think about some strategies here. One thing that we can also do, in addition to focusing on those factors of our score, or kind of those non-traditional or traditional credit products that we can use, one other way to really create a stronger score is we can do what's called piggybacking, or we can basically, this is where someone allows you to be an authorized user on their account. Okay, so what this does, and you could also do this for someone as well, and maybe your score is higher. You know that you're going to be borrowing together towards a home loan, and at this point you really need to, you're going to go into a joint mortgage, and maybe the husband or wife or partner, one or the other score is just slightly out of balance. You can use this approach to add some point value into the overall credit score. So basically what you're doing is you're piggybacking or using the stronger score to kind of offset this person's lower score. And what you're trying to do is really try to maximize the point value to acquire that line of credit that you need. Now, the way this works is if that person is an authorized user, it's a two-way street. So I want to give you, a few words of caution here as we try this strategy. I want to be very careful when we're doing this, because if the other party is using this card and accumulating a lot of debt, both of you will pay the price. It will have an impact on both scores. So piggybacking is one of those strategies, again, that we want to be very careful with as we're building credit, maybe for someone at the college level, or it can be used in all sorts of different scenarios, but particularly a younger borrower, we might allow them to become an authorized user. Again, some parents on the call may be cringing as they're hearing this, but these strategies can be used in various ways. It's really how the strategy is going to be implemented and whether it's going to be effective or not. Can we do it well? I wanted to raise this because I have seen legitimate uses where families really work together to make this work. I've also seen it where it has been a disaster. But I wanted to show this to you, and just basically as we think about credit building and maximizing the score, done well, it can be an effective strategy to kind of move both parties in the same direction, get you aligned in your goals, and also really kind of add some efficiency to building your credit score. But you want to be cautious about it, and if you don't think that approach is going to work well, just completely stay away from it. But I thought I'd offer it to you as a creative remedy as we think about ways to kind of think about time and building a strong score, knowing that we want to really get that product or service from the credit union and that we need to kind of move quickly. It can be an effective strategy if done well. The other one is a cosigner. And again, some folks on the call may push back on this one as well, but I thought I would put this out as a strategy. Both of these, I think, come with some risk, but done correctly, and it can be, again, used to really align your goals and to help with a credit line. Basically, cosigner, the big worry here is if the borrower defaults, then you are essentially responsible for that line of credit. But sometimes we need a cosigner to essentially get a line of credit. So both of these strategies come with some risk, but I thought I would provide them in that rare situation where you really need a line of credit and we're looking to maximize time and our resources. So if you have any questions about either one of these strategies, please let me know. Now, that kind of summarizes a lot of our credit score, credit factors, those sorts of things. I'm going to walk us into this fourth part of our presentation, this fourth step, really looking at how we adjust debts. Okay, now notice in this first line, and I want you to read along with me here. I say debt management is important and essential to financial security, but debt management alone will not serve as a credit building strategy. Will not serve as a credit building strategy. Paying debts alone does not build credit. So what I'm trying to aim at here is while we're doing all this work to minimize debts, we also have to make certain that we're following some of these other credit building strategies to build our score, to build our capacity. And in other words, we don't want to focus so heavily just on reducing debts that we're not focused on, building positive payment history and working on our credit. Another way to look at this is, let's say that you've got some collection accounts and you're just really focused on paying off those collection accounts, but we're not really focused on building positive payment history or having open trade lines at this point, open lines of credit. If you're focusing so much on debt management that you abandon some of these other credit tools and strategies that we've talked about in previous slides, then debt management alone is not going to build your credit score. It's not going to get you the credit score that you need to get the line of credit that you need. So I want you to, kind of think about that concept. You really want to kind of do both of these approaches in a strategic way and not get so hyper focused just on the debt side that we forget that we need active open trade lines to build our credit score through time. So I'll give you a couple examples of what I'm talking about. So when we're looking through On the debt management side, we can always look for what we call the low-hanging fruit. What can we do quickly? What can we do that's going to have an impact on our report, on our score at this time? And I've given you a couple of different examples here. I want to start with this one that's at the very bottom. It says, weigh the costs and benefits of paying debt and collection items. I actually had a really interesting conversation with someone here at the office today as I worked through a credit report, and they were very focused on the collection side. The problem is, even if we paid those collection accounts off today, it still would not have had a larger impact on the score. So that's where I take you back up to the top where we talk about low-hanging fruit. Let's say we've got a couple cards that we can quickly pay off. Then we can actually diminish, our outstanding balances. We will leave those cards open. We reestablish some strong payment history. That's going to have a higher impact on our score and improving our score than just saying, okay, we're going to pay off these 3 or 4 collection accounts at this time. We will get to that. But the question is that our priority at this time? What are we really aiming at? And again, I emphasize what I said in that previous slide. Focusing simply on the debt management side is not going to build the kind of payment history and credit history that we need. So we have to do kind of 2 things. Prioritize. We want to pay those accounts down, certainly, but what is our goal? What are we aiming at, to get the credit line? What should our priority be at this time? So think about it like this. Aim for those low dollar amount cards, pay those off, look for that low hanging fruit, something that we can really do to shift that credit debt ratio. We don't want to close accounts. We want to keep those open, use that 30% rule that I talked about. That's something that's going to have a pretty big impact. Even if you cannot, think back about that slide I showed you with utilization, and you have the chart that shows, the higher score and utilization, lower score and high utilization. Go back and look at that, because even if we don't get quite to 30%, every increment that we're paying down in debt is going to help move that score upward. And that's really what we want to do to rebuild our credit score. So take a few minutes to read through this later tonight and really get a good understanding of, how to prioritize some of these accounts and really focus on what we call active open accounts, paying those down. That's going to have the bigger impact on your score as opposed to simply focusing on the debt management side. So now I'll introduce a couple of very specific debt management or debt repayment strategies. I'll give you 3, and then we'll probably open up for some questions. So the first one that I'll introduce is what we call credit utilization. So again, going back to the chart where we showed utilization, high score, low utilization, high utilization, low score. Here's a very practical way we think about this. But what we're doing here is really focusing on efficiency. Now, again, working with someone here today, they called and they were very tired. They were focused so much on just paying out some outstanding debts that they needed a new strategic approach. And this is exactly what I'm talking about here. They're actually focused here on interest rate, which I'll introduce to you in just a moment. They were really focused on this side. And I was trying to shift them towards focusing on this. Low-hanging fruit, shifting credit debt ratio down to 30%. Because what we're looking at, let's say you have 4 cards. What we're trying to do is across those 4 cards, use our budget, pay down till we get 1 card down to 30, card 2 down to 30, 3 and 4 down to 30. Now our utilization is at 30%. Notice I didn't pay all of them off. I wasn't entirely focused on the interest rate. I was really focused on essentially prioritizing these from the lowest to the highest dollar amount. That creates a lot of efficiency. So this is that credit utilization approach, prioritizing accounts from the lowest to the highest dollar amount, shifting that credit debt ratio across all cards down to 30%, then we pay off, as opposed to what we call the interest rate method. Here, what we're focused on is the highest dollar or the highest interest rate, the lowest interest rate. And we're trying to figure out a way to just really attack that high interest rate, because our concern is that it's costing us too much money, and we want to pay that off quickly. So as opposed to that other approach, I have seen this to actually be fatiguing, okay? And I note this in the slide, that basically what we're doing is we're spending all this time trying to pay off that 28% interest rate, that we don't have our debt structured in a way that creates efficiency, and we burn ourselves out. So what I would do is I would actually just encourage you to kind of read through this method, figure out which one of these you think is most appropriate for you at this time. I would recommend that credit utilization strategy for low-hanging fruit, pay them off quickly, change that credit debt ratio. It's very efficient. But there are certainly times where you may use this interest rate approach. Maybe you don't have several cards, and the approach that you would have to take just practically is this interest rate approach where you pay off a higher interest rate card first. So basically, this allows you to kind of structure through time, figure out 6, 12 months, however long you think it's going to take. You want to create a consistent payment amount focused on that highest interest rate card, and then move our way down into our lower balance cards. That's the interest rate method. And then lastly, we look at what we call the rollover method. So this is where we, again, lowest to highest dollar amounts. That's our priority, lowest to high. We pay off, let's say that we have a card that's in the $800 range. We pay it completely off. We take those funds, we roll it towards the next card. In addition to our monthly payment, we put that extra $100 or $125 towards that card. We pay it off. We continue to roll forward the dollars that we have. Having paid off those accounts, we roll those amounts forward so that now we have the structured plan over 6 to 24 months to really pay off our debt using this particular approach. I've noted here that I think that this is a motivational way to do it, and it's also very efficient in terms of improving your credit score. Just sharing those tips with you, years of practice and seeing how this works. But the rollover method is nice because you get to see an immediate impact in your credit score. Having reduced those account balances down, you'll see your score move. That gives you some motivation. And when it comes to personal finance, we certainly need that when we're paying off debts. So lastly, this is where we really make all this count, okay? This is the summary. This is how we get there. Reach out to us at Trinity. When I say free, it truly is free. We'll pull a credit report for you. I will go through the steps that I've recommended today, and really work on just creating and aligning some really good credit strategies for you. The other thing I would do is it's important when we talk about a partnership with General Electric Credit Union. In addition to the work that I do, that work would be aligned towards your credit needs and goals so that you get the line of credit that you're looking for through the credit union. That's where I can work with a loan officer or work with others to do this type of work. That's really what we want to do, is have a good partnership to help you get the products and services that you need, reach those larger financial goals that you need. We can do that together. So reach out and let us know. All you have to do is give me a call. I can run the report and really set you in a direction so that when you go back to the credit union, you have specific steps to get the credit that you need, get the loan that you need. The other thing too is that some of us may be in different places on the call today. Some of you may be looking to establish credit. Some of you are certainly rebuilding credit. Since this last year has been difficult for all of us. But, again, this is where we use products and services to get us there. So if you need a secured credit line to establish credit, that's where we start. Folks who are on the call that are rebuilding, that's where we're getting creative with some of these strategies, figuring out what is the most efficient approach, what's the best approach, what can I do using credit scoring as a strategy to kind of efficiently use that method to get us, within 6 months to get a home loan or a car, whatever it may be. So we're in different places on the call. And in both cases, though, we can certainly find the appropriate strategy and the appropriate tool, type of loan, to actually rebuild our credit or establish the credit that we need. And then lastly, I've kind of put these in. Certainly, if you're a thin file or new to credit, it's going to take, we always have a time dimension to this work. If your score is on the lower side, you know, 24 months, I always look out over the last couple of years and we look ahead, because there are no quick fixes when it comes to this work. And you hear a lot of information out there, a lot of chatter online, a lot of sorts of things, personalities on TV, all sorts of things. Rest assured that there are no quick fixes when it comes to building credit. We follow the rules, we implement strong strategies, and we work with the credit union to really do this work correctly. That's how we get there, as opposed to trying to, figure out some other remedy. There are no other remedies. It's just hard work and making certain that we have sound plans. And that's certainly why I'm here today and why the credit union is holding this presentation for you. So that brings us to the end. Kelly, I will turn things back over to you to talk a little bit more about the products and services and some of the things that are offered through the credit union. But I certainly want to say I appreciate your time and that I welcome any questions that you have today.
Awesome. Thanks, Todd. Everyone, as Todd mentioned, we'll go ahead and get to the Q&A portion. The first one is, can you talk about the mid-score example, what lenders look for when buying a home?
Sure, and Kelly, you may be able to answer this as well. So different different credit unions, different banks will all have, when we talk about that minimum score requirement. So if you're a conventional buyer, and I'm not certain exactly what that would be at General Electric Credit Union, in many cases, what we're looking at is we might say we need, a 670, we might need a 680 as a conventional buyer, with, a certain percentage of funds for a down payment, even if we don't have quite the full 20%, that we still have that minimum score requirement. We're really thinking strategically. So if we pull what I'll call a baseline score, and right now we're at, let's say we're at 645, and we really need to be at that 670. What we do is we use some of the tools that we've talked about today. We look at aligning our strategies so that we can really get to that minimum score requirement of 670. That's really what I was trying to focus on there. We get a good read on basically where we're at today, and then what steps or actions do we need to take, or sometimes even maybe even having an additional line of credit that works us towards that larger goal. And certainly Kelly will be able to reach out and find out what those score requirements are. And on my end, if you have any questions about that, I can always pull a credit report for you and work with the credit union to really strengthen your score to get that line of credit.
Okay, and I have two more questions in the chat. This next one says, I had a perfect 850 FICO score for years, but as soon as I paid off my mortgage, my score dropped 20 points. Is this because I dropped one type of credit?
Well, I'll be honest with you. 850 score, paying off the mortgage, I can't really tell you. I would have to look broadly at your overall credit. We would have to run a credit report for me to be able to give you a very specific answer on that, because oftentimes we have multiple lines of credit. Paying off something like that at that high score range, it's odd to see a score drop after being in a higher range like that. So in order for me to give you an accurate read on why that score would have dropped, I would have to look at the broader credit report. Although, rule of thumb here that you'd always want to follow is you want to really think about active open trade lines. So if you have loans that were open, this one particular line being paid off, and why, really to be able to answer that question, I'd have to look at the credit report broadly. But certainly in that scoring range, you're at the higher end of the scale.
Okay, and then we have one more question. Would you just mind clarifying quickly the difference between piggybacking and co-signing again?
Yes. So in the piggybacking example, what you're doing there is essentially it's an authorized user. So party A or B, whoever is the primary card holder, would allow someone to become an authorized user on their card. You would give authority. You'd call let's say you'd call the card holder would call someone, Chase Bank, whoever may be that offered these credit lines. That person then becomes an authorized user on your credit card. As opposed to a co-signer. Co-signer means that you are signing in addition to that primary borrower. If that primary borrower defaults on the loan, you're actually liable for the entire balance. So in that first example of piggybacking, you're using someone else's higher score to basically their higher score is also reflected on your credit report. But it's not the same as saying that they're entirely responsible for an outstanding balance if you were to default. So it's really that question of the difference there is just, co-signer comes with a great deal of risk because if the other party doesn't pay, you're fully liable for the account balance, whereas in that other example with piggybacking, you're not.
Awesome. Thank you for clarifying. And thank you so much for your time today. Everyone, that concludes our Q&A session. If you have any further question, Todd's contact information is up on the screen, or you can reach out to our events email. It's events@gecreditunion.org. I'd be happy to pass those questions over to Todd. And with that, thank you all for joining us and have a wonderful rest of your day.